Good day. For this session, we are going to discuss about cash flow and capital budgeting. So you can see here on the screen a picture showing about sources of cash flows, but basically this is for economics perspective or government. So you can see that cash flows can be coming from businesses and they can be in the form of rent, taxes, and wages for employees. So anyway, that's besides the point because this is financial management. So I'm going to lift the source from the book of Smart and Meganson, and this is the discussion of cash flow and capital budgeting part 1. Now, we all know that for financial management, cash flows are very important because this will be utilized in order to further the main objective or the main objective of the organization and financial management respectively, and that is to maximize shareholders wealth. So the first point is about cash flow versus accounting profit. So we all know that the two items are very different. Cash flow is under cash basis of accounting, while accounting profit is, of course, under accrual basis of accounting. Financial management, as what I've said in the previous discussions, is focused about cash flows. On the other hand, accounting profit is, of course, for our financial accounting and reporting. So capital budgeting is concerned about first one, cash flow, not the accounting profit. For us to properly evaluate a capital investment, then we must know first the marginal cost of investment. Whenever we hear the word marginal, this is an economics concept, which means the extra or additional. So from the word margin. So if you think of a paper with the margins, those margins are to be left out without any writings. So these are the portions in which we think of additional items, incremental cash outflows of the investment, and of course the inflows, incremental cash inflows of the investment, which are the marginal benefit or benefits of investment. And of course, it follows that benefits must exceed the cost, as said in a lot of occasions already. So it's going to, of course, have impact on the calculation in terms of timing. So when will the cash flows be there? Like the cash outflows, which could be at time zero, as opposed to cash inflows, wherein they can happen anytime along the way. And of course, we are going to pair them with a respective discount rate and compute the present value of cash flows. As discussed also in the first chapter, that there would be an impact also on the computations because the earlier the time is with respect to the discount rate, the greater the present value factor. And the bigger the n, meaning the number of periods, then the lesser the present value factor would there be. And therefore, it would, of course, have lesser present value of cash inflows. Remember, cash inflows are, of course, computed at present value on the sense that they are to be there at certain points or periods of time, not necessarily like same time. All right. So on another occasion, there would be concepts or discussions about the financing costs and taxes. So financing costs basically are the interest that we talk about and the taxes. Financing costs should be excluded, of course, and then well, anyway, these are the costs on top of the interest per se because interest or the discount rate should be included. Then both interest expense from debt financing and dividend payments to equity investors should be excluded as well. And financing costs are captured in the process of discounting future cash flows. Exactly. So the point here is that even if we do not include financing costs, or the reason that we exclude financing costs is because they are already captured in the discounting impact using a certain discount rate, which could be the cost of capital. Then only after tax cash flows are relevant as only such cash flows can be distributed to investors. Remember, the taxes which are, of course, computed at the tax rate times the amount of cash flow will be remitted to the government agency in charge for that. So Philippine setting, that would be the Bureau of Internal Revenue. Then what about for non-cash expenses? So there are some expenses wherein they are to be deducted for the purposes of computing net income in our financial accounting and reporting. However, they are basically not non-cash expenses. So examples of that would be depreciation, amortization, and depletion. Depreciation for property, plant, and equipment, amortization for intangible assets, and depletion for wasting assets or mineral resources. Accountants charge depreciation to spread a fixed asset's cost over time to match its benefits, right? Because, for example, for property, plant, and equipment like building, the cost of that asset will be spread over or can be utilized throughout its useful life, which is estimated, say, for example, 30 years. So it's very mismatched if we are going to charge like millions or billions cost of building one time, and it would, of course, suffer the performance in the short term, but that can be utilized for 30 years. Therefore, there's a need to spread the cost over the time so that you would have the matching of benefits and costs. Then capital budgeting, as always said, will have to focus on cash inflows and outflows as to when they occur. So meaning time is very important. Is it at time zero or after the end of first year, second year, etc.? Then non-cash expenses would also affect the cash flow through their impact on taxes. So we can compute after-tax net income and add depreciation back, or we ignore the depreciation expense but add back its tax savings. Okay, so for the first one, this is like the most common one that can be seen in a lot of financial management books. So when we compute the net income, whatever that is, we are going to net the tax, so minus the tax rate, then multiplied by the amount of net income that's going to be the tax, and then deduct, and we add back the depreciation, which is, of course, prior or without yet the impact of taxation. On the other hand, we can exclude depreciation expense as well as the other non-cash expenses, but there would be tax savings. Why? Because supposedly, if there are more expenses, then the lesser the net income and the lesser the taxes. So that's why there are tax savings. To illustrate that, so let's have here, for example, we assume a firm purchases a fixed asset today for $30,000, and then the depreciation is using straight line method. So that's simply the depreciable cost, which is the difference between the acquisition cost or the total acquisition cost less the salvage or residual or scrap value divided by the useful life in years. So basically that's going to be 30,000 divided by 3, and that's 10,000 per year. Then the firm will produce 10,000 units per year. We have here the cost, $1 per unit, and the selling price is $3 per unit. So another assumption is that the firm pays taxes at 40% marginal rate. So you can see here, using the two methods as discussed a while ago, that we can compute the pre-tax income or the tax before any taxes. So you have here computation of sales down to pre-tax income. You can notice here the depreciation deducted. So to simplify the illustration, of course, depreciation is just shown here, but we all know that depreciation is just but one of a lot of items under expenses. So we have here the 10,000 pre-tax income, then taxes is 40% of that 10,000. So that's 4,000 pesos. 10,000 minus 4,000 is 6,000. And should we add back the depreciation of 10,000, this is the cash flow, that is net income plus the depreciation expense. And another method is that we are going to have the pre-tax income shown here, but we do not deduct anymore the non-cash expenses. For example, again, depreciation. So just 20,000 less the taxes equals after-tax income. But we are going to add back the depreciation tax savings. So this is also another formula that we can take note of. However, I would say that method one is a much better approach because we can just refer or base it on the illustrations under financial accounting. So whatever is the after-tax income, we just add back the depreciation, depletion, and amortization and other non-cash expenses. So in fact, it is just non-cash expenses here being shown, but the gains also are non-cash items, but they're added back. So that's why to compute the cash flow, they are going to be deducted as opposed to the expenses non-cash, which are added back. Right? So I repeat, non-cash expenses to be added to the net income after tax to get the cash flows, but non-cash gains or income should be deducted. Okay, so depreciation actually would depend upon some countries. Some countries have a lot of methods like the MAC-RS. So this is shown or this is being used in US, not in the Philippines. But the point of MAC-RS is an accelerated depreciation method, which means that the depreciation would be greater like at early stage and would actually decrease. So basically, there's a bigger depreciation at early years and would decrease. And of course, that would make the depreciation faster to be computed and calculated and applied to the cost. So on the other hand, if we think of straight line depreciation as opposed to accelerated depreciation method, that is MAC-RS, it would result to higher reported earnings early. Okay, that's true because it is spread out, or the it is the cost spread out over its life and it's constant. So MAC-RS, of course, would be resulting to lesser earnings because there are greater depreciation expenses at early years. So this is also true that some countries or many countries would allow different depreciation methods for taxation and reporting. All right. So depreciation only affects cash flow through taxes. Then we consider only the depreciation method that a firm uses for taxation purposes or tax purposes when determining project cash flows. Of course, because the actually tax savings would be based on the taxation method and the depreciation method that is allowed. So in this case, I would say method two. Let's go back to method two. Method two would then be very helpful because the tax savings here to be added would be, of course, based on the depreciation method that is allowed under taxation. So that's going to be the tax savings. And then here is an illustration of the. All right, so this is the schedule being shown under US tax depreciation allowed for various MAC-RS asset classes. So as being shown here, MAC-RS stands for Modified Accelerated Cost Recovery System. And that's the reason that, again, there are greater or very dramatic and big charges in early years. And the shorter the period, of course, the greater the percentages at the early years. So we can see here for 3 years, at year one, this is the rate, and so on. It decreases to a certain extent. But I noticed that on the second year, that's the time that the rates are being shown at greater value. So I don't know like how these are computed, but basically this is how they actually made the said schedule, and this is the presentation. So if this is the real practice in US, we're just going to make use of these rates. And for Philippine settings, so we do not make use of MAC-RS. Anyhow, fixed asset expenditures In terms of expenditures, that's the word for cash flows, and especially cash outflows, because in expenditures, we are going to talk about disbursements or payments. And then expenditures are not the same or synonymous with expenses. Let me highlight that. And then expenditures basically are values that are, again, outflows. So the company pays for such. So that's why for the illustration here, initial cash flows, we have the cash outflow to acquire or install fixed assets. Then that's going to be, of course, an expenditure. The inflow from selling all the equipment, this could be the concern now. So how is that going to have impact on our computation? Cash inflow or outflow of selling all the equipment below or above tax basis generates tax savings or liability. So if the inflow would be there, so it can result to a saving. And the outflow, of course, will for a liability, or will be for a liability. So example here, tax rate is 40%. New equipment cost at $10 million and installation cost of 0.5, that's going to be a total of $10.5 million for the outflow. Then for the after tax inflow, so $1 million, then we are going to multiply that with 40% rate, that's going to be $0.4 million. So the net value is $0.6 million for the purpose of computing the initial investment. Okay, so that's how we are going to actually present this particular case. So in other words, the cash inflow would be after taxes. The taxes are to be deducted then. All right. For working capital expenditures, if you are done with other finance subjects, so probably you will know that the working capital, especially the net one, is the difference between current assets and current liabilities. So when there is an increase of the NWC or the net working capital, that's going to be a cash outflow, while a decrease is a cash inflow of that. So if there's a decrease, meaning lesser investments on assets, or it could be like more payments of the liabilities. Okay, so that's why there would be a decrease in the net working capital in such situation. Or just to clear that out, so if you say cash outflow, that means an increase in net working capital. It's because we actually invested more on current assets with the same liabilities, or if we talk about with same assets, so probably liabilities here are being paid at, so lesser liabilities. That's why there would be an increase. On the other hand, for the decrease, it would be like lesser investments for current assets, but we actually had more liabilities to begin with. So that's why there would be a decrease of net working capital. So you have here an example. So these are the details being shown. And that's why for the computations, you have here cash, inventory, these are assets, minus the accounts payable, that would be the net working capital as we speak. And this would be the monthly change in working capital. So at first month, that would be 0 minus 0 prior, so not applicable. In November 1, it increases to 500, so that's plus 500. To 1,000, another 500. It decreased to 3,000, so that's minus or negative 4,000. To become 3,000, we are going to deduct negative 4,000, from 1,000. And so that's why we have negative 3,000 as a result. Then in February 1, the net working capital is 0, so that's going to be plus 3,000, so that the resulting figure is 0 from 3,000 plus negative 3,000 pesos. You can notice here that for cash October 1, that is zero because it's the start of operations and it will end by January 31 of next year. So by February 1, that's also going to be zero. And beginning, so zero balances at the beginning as well as the end or at the end of operations. Then we're done with computations of the net working capital as well as the monthly change in working capital. Then the payments and inventory here, reduction in inventory is actually coming from the 15,000 given calendars inventory, and then 30% will be expected to be sold for cash in November, 60% in December, and 10% in January. So that's why you can see these particular items here. For payments, it is based on the given $5,000 per month. And then that's why this would be the resulting net cash flow then. So the difference between sales and the payments. All right, so that's it for discussions involving computations of net working capital. After that, we have the terminal value. From the word terminal, that means the value at the end of the project. So when evaluating an investment with indefinite lifespan, the project's terminal value is calculated. So you have here, for example, construct cash flow forecasts for 5 to 10 years. Then forecasts more than 5 to 10 years have high margin of error. So that's why we are going to use terminal value instead. So in other words, for more than 10 years, for example, because of high margin of error in terms of estimation, remember, we are going to estimate the values of these cash flows that will happen in long run or in the future time. So that's why we are going to encapsulate the value into one value, and that is the terminal value. So this is intended to reflect the value of a project at a given future point in time. Then the terminal value is usually large relative to all the other cash flows of the project. Basic reason, it's because we are now estimating its value that is beyond the 10 years time. So what are the different ways to calculate terminal values? So we can use the final year cash flow projections and assume that all future cash flow grow at a constant rate. So we can do that like the end, for example, of the 10th year, and then we assume that the growth rate will be constant years after. And then multiply final cash flow estimate by a market multiple. So let's say at the end of the 10th year, then multiply that with a certain multiple, could be let's say 10 or 12 or whatever number that is, or we use the investment's book value or liquidation value. So example here would be the case of JDS Uniface cash flow projections for acquisition of SDL Incorporated. So you have here the given cash flows from years 1 to 5. So how do we compute the terminal value of SDL acquisition? So assuming that cash flow continues to grow at 5% per year, so we have here the terminal value of the acquisition PV is cash flow T plus 1. So you have here $3.41 billion. This is beyond 5 years. So at the end of year 6, this is the cash flow. And then rate is 10%. The growth rate is 0.05. So if we simplify this, we get $68.2 billion. And that will be the terminal value. So the terminal value is, in fact, $68.2 billion and very big compared with the cash flows, even the total of the prior years from years 1 to 5. So value of entire project then is $48.67. So 42.4 billion of total 48.7 billion is from the terminal value. I said a while ago that it constitutes the large or big portion of the entire value of project. So we can also notice that the $68.2 is discounted at the rate the R, the discount rate, which is 10%. So that's why it is 1.1. And then the year is 5. So at the end of the 5th year, that is, we are estimating actually. So this is divided by 1.1 to the power of 5, as well as the rates prior. As said in mathematics, if, for example, a negative exponent is placed on the numerator or opposite, then its sign would change. So if this is like beside $68.2, that's going to be the quantity enclosed in parentheses 1.1 to the power of negative 5. But if we place that again under the denominator, so the exponent's value would change to 5. All right. Then using price to cash flow ratio of 20, so this is using the multiple. So we can simply multiply, for example, the terminal value, $3.25 times 20, which is the value at the end of the 5th year. Or if, for example, we have here the other amount. So for a while, because it cannot be seen here properly. So the caveat, meaning the warning here or the cash, is that the market multiples fluctuate over time. So that's also the concern if we use price to cash flow ratio. Then incremental cash flow, or again, the marginal or additional cash flows. Incremental cash flows are cash flows that would differ among alternatives or choices or options. So again, they are marginal. They would be different if we think of different options or alternatives. So that's why they're also known as marginal or differential cash flows. So they wouldn't be incurred, they wouldn't be there had the company not entered into a project. So that's why they are differential or incremental cash flows. Then if we are going to compare them with sunk costs, in which sunk costs are actually the costs that actually cannot be obtained by us again, and they cannot be recovered anymore or any further. We have to take note that we are going to put a check for incremental cash flows while an X for sunk costs. Analysis should only include or involve incremental costs. So example here would be, let's say Norman Paul's current salary is $60,000 per year and he expects it to increase at 5% each year. So for that alone, we can say this is really relevant because of the increase, which is differential or incremental. The tax rate is 35%. This will also have an impact because we said that we are going to include taxation in our analysis. Some cost would be an X. Let us take note though that sunk costs could be really sunk if we think of one situation or case. But in some cases, or if we take these costs to another situation, they may be relevant or incremental. Then room and board expenses are not incremental anymore to the decision and to go back to school because they were already incurred and we can no longer change them no matter what we do. So example, continuation, at the end of 2 years, assume that Norm receives a salary offer at $90,000, which increases at 8% per year. A while ago, that was 5%. Then expected tuition fees and textbook expenses for each of the next 2 years while studying for MBA is $35,000. If Norm had worked at his current job for 2 years, his salary would have increased 60,000 times 1.05, that is squared, equals 66,150 for the 2 years time. So this was the assumption a while ago, that the 60,000 per year assumption would increase at 5% each year. Then the year 2 net cash inflow then would be 90,000 minus the 66,150. This is the 23,850. The 66,150 is basically the opportunity cost. Now, what is that, or what was that all about? So the current salary is this 60,000, and then to increase at 5% each year. Another option was that Norm would receive a salary offer of $90,000. So the net would be 66,150 or 150 deducted to 90,000. That's 23,850. And if we are going to compute the net of taxes for that, which is at 35%, then at year 3 cash inflow, that would be again 90,000 times 1.08 minus, at this time for 60,000 salaries, that would be exponent of 3 years. Then we net also the taxes to get the net cash inflow. So MBA then, our case here is that studying for MBA, then this is the cost at $35,000 tuition, and then these are the expenses, of course, given at 35,000 plus the 90,000 salary that can be received by Norm while studying for the MBA. In other words, we can then say that Norm has an option to just work or to study while working in MBA. So that's why if we can notice here for the computation, the year two net cash inflow is 90,000 minus the 66,150. And then we continue the analysis, and that would result to MBA studying while working a substantial positive NPV value for 30-year analysis period. And then what about Norm's opportunity cost then? So meaning if you say opportunity cost, this could have been earned, but this becomes cost because it is basically a benefit foregone in choosing or favoring one alternative over the other. So we have here cash flows from alternative investment opportunities foregone when one investment is undertaken. If Norm did not attend MBA program, he would have earned just the 60,000. Then we deduct the taxes a while ago, that was 35%. All right. Then we can see that 39,000 taxes would be the inflow after taxes. And second year, because it would increase by 5%, so 60,000 increased to 63,000, then the net cash inflow after taxes would be 40,950. So we can see that on our respective PowerPoint presentation. Anyhow, the 40,950 amount or value here, that is the cash flow after taxes, can also be computed as 39,000 times 1.05. So 5% increase if you would like to have a shortcut. NPV of a project could fall substantially if opportunity costs are recognized, because this would be deducted then from our inflows. So this will be part of our costs or deductions. And of course, deductions would decrease the net present value of cash inflows. All right. So that's the point of opportunity costs. Another one is called cannibalization. So if you say cannibalization, when a new product is introduced, then there would be loss of sales of an existing product. From the word cannibalization, so one item sales or market is eaten because there is a new product. So this is called a substitution effect, probably because the newly introduced product is a substitute, or let's say of a similar nature or industry of an existing product or the existing products. All right, so we have here an example of that situation. So classicaltunes.com is considering adding jazz recordings to its offerings. So these are additional products which could have possible impact to additional products. And here are the given items prior to the lengthy analysis. So 10% discount rate and 40% tax. Then selling price is expected to remain constant for the CDs. Then sales expected to begin when the new fiscal year begins. And here are the initial investment transactions. So $50,000 for computer equipment, Mac RS 5-year, $4,500 for inventory, $2,500 which is purchased on credit. It doesn't matter, but this is going to be an accounts payable. And we have $1,000 for a while. So it can actually prevent me from seeing the items at the bottom. The it is the software that I am using for recordings. So $1,000 increase in cash balances. Okay, so I'm just going to make this way of presentation then so as not to obscure my site. So we have here the projections for Jazz CD proposal. We can notice here that the prices are constant and then the units here are increasing. So we have here for abbreviated project income statement. So from revenue down to pre-tax profit, and then the taxes, of course, at 40%. Then after tax profit. So what about on the balance sheet? So we can notice here the cash, AR, inventory, current assets, and the PPE, and accounts payable a while ago, knowing that 2.5 of which is purchased on credit. All right. So in this particular sense, this is like how we are going to show the projections following the given items. For Jazz CD proposal, this would be the annual net cash flow estimates for classicaltunes.com. So new fixed assets would be same. Change in working capital, there would be impact. Then net income, depreciation, and this would be the net cash flow. So for the change in working capital, of course, if there would be changes on the value, so example here, the difference between current assets and the accounts payable under current liability, that's the working capital, that's 5.5 minus 2.5, that's 3,000. Since current assets is greater than current liabilities, then we are going to deduct it, meaning we think of the opposite. Although we know that equity has direct correlation or relationship with assets, such that when assets would be plus 3,000 increase, then equity would be plus 3,000. That's true. Although, because we are thinking of the opposite, that's why that $3,000 would become a minus to compute the net cash flow. Remember, the increase of assets, which would be tantamount to increase in equity, is under accrual basis of accounting. For cash flow basis, we think of the opposite. So that's why this would be a minus 3,000. So whenever current assets would be higher than current liabilities, so we are going to deduct it. And if the opposite is true, we are going to add back, such that current assets would be lesser than current liabilities. Then net income is to be copied from here. So that's going to be the after-tax profit. So meaning the amounts here are given if they are not to be computable from this given problem. Then going back, depreciation is to be added back because it is a non-cash expense. Should there be non-cash gain, that will be deducted also. Okay, so that is for projections for Jazz CD proposal. Then another one is for year zero cash flow. We have here the net value as said a while ago. So that's $3,000. And as what I've said, current assets are greater than the current liability. Okay, so that's going to be the 3,000 change in working capital. For a while, this is supposedly accounts payable. Okay, let's verify then. We're going to learn together. Yeah, 2,500 of which is purchase on credit. So this should have been accounts payable. All right, so accounts payable. And that's why if there is an initial cash outlay of 50,000, so when current assets would be greater than the liabilities, that's going to be a positive amount. But for the purposes, again, of computing the net cash inflows, it will be deducted. So you have minus 50,000 for the acquisition and minus 3,000 to get the net cash flow. Then year one cash flow is, of course, whatever is the after-tax income, then we are going to add back the non-cash depreciation. And what happened is that there is net working capital of 10,282, which is actually a plus. So meaning we are going to deduct that to be able to compute the net cash flow. Now, this is the amount in year one. Prior to that, so at time zero, there is 3,000, correct? That's 3,000. So that's why this amount, $10,282 minus $3,000 equals $7,282. And this is the amount that we are going to deduct from our total of 561 after tax income, then plus the non-cash depreciation expense and minus this amount. And same concept will be followed for the rest of the years. So we can see here the year one cash flow. So it's here as to how we computed then. So meaning there are two ways to compute the $7,282. It could be this one, which is the change in net working capital of year one and year zero, or simply whatever would be the increases or changes of working capital items, then we are going to, of course, partner them to get 7,282. So in other words, guys, before we forget, the computation here is based on changes in working capital. So that's why it's here. So change in working capital, $7,282, and that is a minus or negative. And then depreciation is at $10,000. That's a plus. Net income is, of course, plus. Add back the depreciation minus this one. I repeat, because this means that the net working capital is plus because also of the current assets change or changes are greater than the change in accounts payable, which is part of the liabilities or current liabilities or the current payables. All right. Then year two cash flow, same concept or principle, just deduct to get the net working capital and the changes from year two and year one respectively. Then follow this formula that net income, we add the depreciation, and if the increase in working capital is of course a plus, we are going to deduct. If decrease, we're going to add plus or add plus depending on the situation, or minus, of course, depending again on the case. So we are going to add again if the working capital has decreased, and then we are going to deduct, just like for this case, because the working capital increased. And then in addition, if the terminal value for Jazz CD proposal, if we assume that, all right, so going back for this terminal value for Jazz CD proposal, again, we can compute the terminal values in many ways. So one way will be if we follow this particular formula, that is the present value of the terminal value is equal to cash flow, that is time at the end of the particular year, for example, fifth year, because the terminal value is to be estimated at that point, plus one, so that is going to be the cash flow estimated for year six, and then to be divided by the discount rate minus the growth rate. To get the numerator, that is simply 1 plus the growth rate times the cash flow for that time. So example would be at year 5. So let's go back to our problem here. At year 5, this is of course the cash flow. But at year 6, this is the amount. Okay, 34,410. So it doesn't necessarily mean that it is still or it is always at year 5. In fact, in the problem, it is shown here that the last year is 6. So we can estimate then the subsequent one. So that's why it's going to be, of course, the 6th year cash flow, which is given, and then times 1.04, which is the sum of 1 plus the growth rate. This is going to be the amount. Then that's the numerator, to be divided by 0.15 minus 0.04. So to close or to remind ourselves for the terminal value, so if we take, for example, the last year is 6, so meaning we use that rate and we compute what would be the increased cash flow by next year. So meaning the 7th year then, all right? But we are computing the terminal value at year end 6 or the end of 6th year, to be divided by 0.15 minus 0.04, and this would be the terminal value. Second approach would be to use the book value at end of year 6. So we have PPE, or in this case, this is plant and equipment, the same at end of year 6 is 0. The firm liquidates total current assets, cash. So we have here the current assets and the debts, 24,300. And then, so the terminal value here is this particular. All right, so basically we can also see this on our respective summary. So we have here on the projected balance sheet, so end of year 6, we have the 50,000 for PPE here, and then current assets here also. So we have, of course, the total assets at same amount as current assets because the net P&A is 0. All right, that's a point. You can notice that the gross property, plant and equipment, or plant and equipment, again, in this problem, less the accumulated depreciation is 50,000, so that's 0 net. And if we add that to current assets, that's going to be same total assets minus the accounts payable, 24,300. And we can see that again here. So terminal value then is the difference between the sum of the assets, so all assets less the sum of the liabilities there are. This would be the terminal value. Again, the terminal means the value at the end of a certain project, just like this one, a Jazz CD proposal. Then what is the net present value for Jazz CD proposal? So that's going to be, as discussed in capital budgeting, the previous chapter, that the net present value is the difference between the present value of cash inflows less the cost of investment. So the present value of cash inflows would be the sum of all cash flows. So where do we see these amounts or values? For the terminal value here, it's shown, right? So the terminal value is this 325,327. Then we add that to the cash flow at, of course, the 6th year, 34,410. For first to 5th year, this should have been 5th. This is 6, this is 5th. Anyway, so 1, 2, 3, 4, 5. This is 5 and this is 6. So we can see them on the computations of the net here. Net cash flows from year 1 to year 6. Do not include year 0. But we are going to use year 0 for the sake of computing the net change in working capital. All right, so if we continue now, we have here the computation. So these are again the present values of cash inflows less the cost of investment to result the net present value. On the other hand, if we use the book value, prior one actually was the preferred method, which is based on a steady rate or growth rate. Second one is using book value. Multiple is not shown here. So using the book value is going to be the same in terms of computing the cash flows methods, except that the terminal value is changed on the book value of the net assets or equity. Remember, total assets minus total liabilities is net assets or equity or capital. And we can notice, of course, that the net present value is lesser using book value versus using the steady rate or growth rate because the terminal value, of course, is greater or bigger using the steady rate, while the terminal value using the book value, of course, the amount here is lesser, so resulting to lesser net present value. The multiple is not shown here because it's not given on the problem, but supposedly if, for example, just an assumption here, we can also make use of that. So whatever is the cash flow at, for example, this year, fifth year, let's say, of course, yeah, you can see here, this is the fifth year and this should be 5 year. And then in the sixth year, this is 34,410 from this value. So this is the basis. And then the multiple is, let's say, whatever is the amount, 34,410 at the end of sixth year, then the multiple is 10. So we just have to multiply that by 10, and that will be the amount here of the terminal value. And we are also going to discount it. All right. Then what's the conclusion? NPV is positive with both methods. So investing in Jazz CD project increases shareholders' wealth. As said in the previous chapter, out of the methods for capital budgeting, we actually prioritize the net present value, and actually we favor that on the sense that it is going to show to us the net present value, which is the difference between the benefits, marginal benefits of the proposal or project, that is in the form of present value of cash inflows, and the marginal investment or cost, in which that is represented by the cost of investment. And there is the term marginal because that's the difference of the two. And there is also the incremental costs or benefits emphasis, such that what we are going to consider would be the costs and the benefits that would be there if we are going to continue with the project. And we would not have them if we did not proceed or we did not pursue the said project. All right. So that's one thing that we should remember about computing the net present value. It is, again, the preferred, if not the most preferred method of deciding as to whether a certain project is to be pursued or not by the management. And of course, if the net present value is greater than 0, so we are going to accept the project, continue with the project, and then it means that if NPV is greater than 0, that would increase the shareholders' wealth, right? So that closes part 1 of the discussions of cash flows and capital budgeting, and stay tuned for the next session. Thank you and God bless.